Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is financing with receivable. What is it? We need money, we go to the bank, we get a loan, and we give our accounts receivable as collateral. And we have some ways to do that. Basically, two ways. Secure borrowing. Pledge accounts receivable as collateral for a loan. Entire receivable balance serves as collateral. Responsibility for collection of the receivables remains solely with the company. The arrangement should be described in a disclosure note. And no special accounting treatment is needed here. And we have the sales of receivables. So it is not a loan anymore. We are selling them. So we have gain, losses, and so on. And accounting treatment is similar to any sale of any other assets. How does it work? Uh, no particular receivables are secured borrowing. No particular receivables are associated with the loan. Rather, the entire receivable balance serves as collateral. The responsibility for collections and everything else remains with the company because we are not selling the receivable, we are only giving them as collateral. No special accounting treatment is needed, but arrangement should be described in a disclosure note. Or we can assign particular receivables to serve as collateral. Example, mortgage on a home. The lender typically lends an amount of money that is less than the amount of receivables. The difference provides some protection to the lender, and the lender usually charges the borrower an upfront finance charge in addition to stated interest on the loan. And the receivables might be collected either by the lender or borrower, depending on the arrangement. So this is how we usually work. And before I start with sales of receivables, let's go to our Excel file. So if you are a regular here, you already know that. If you're not, I want to let you know that all our Excel files, they are free to download it. And the link to download it is in our video description. So what do we have here? On April 1st, 2020, the Skyping Corporation borrowed 1 million from Corinthians National Bank. It is not a real bank, and Corinthians because it is my soccer team. So we have this fake national bank as well. And signed a promissory note. Interest at 10% is payable monthly. The company assigned $1.3 million of its receivable as collateral for the loan. And Corinthians National Bank charges a finance fee equal to 1.5% of the accounts receivable assigned. So 1.2%, 1.5% of the $1.3 million. And Skype Incorporation will continue to collect and will record any discount and so on. And we assume that 900,000 of the receivables assigned are collected in April. So what do we have here? Let's delete it. Liability. Liability is $1 million. $1 million here. Finance, the fee, it is $1.3 million times 1.5%. So it is 19.5. And the cash is the number to balance. So 1 million less 19. So it is 980. That is this 1.5 here. That is what we have here. Uh, the lender usually charges the borrower an upfront finance charge. So it is this 1.5% here. We received $900,000. So cash, $900,000 because we are responsible for this collection. Accounts receivable, $900,000. So we still have $400,000. And what do we have here in our interest expense? Interest expense is 10%. So 10% is payable monthly. However, 10% is not per month. 10% is per year. And usually we work with simple interest here. So 1 month has passed, so $1 million times 10% divided by 12, $8,000, $8.3 thousand. Our liability, our financing will be how much we collected. So it is $900,000. What about cash? Cash is a combination of both. So we still have $400,000 on accounts receivable. However, only $100,000 of the financing arrangement. So next month, if we receive 200,000 or 300 or 400 or any number above 100, we will have this journal entry here only for the 100 remaining. Okay, guys, so this is the secure borrowing. The most common one, however, is not this one, is the sale of receivable. The accounting treatment is similar to any other sale of the asset. We remove the receivable from account, recognize at fair value any asset acquired or liability assumed by the seller in the transaction, and record the difference as a gain or loss. And here we have only one journal entry, much easier. However, we have two different sales of receivable, with or without recurs. If it is without recurs, the buyer can't ask the seller for more money. If we have a huge bad debit, that is the problem of the bank, not ours. When a company sells an account with recurs, the seller retains all the risk of bad debit. So if we have a lot of bad debits, the bank can ask us more money. However, usually with recurs, we have a lower factoring fee because we are assuming the risk and not the bank. How do we do that? Let's go to our Excel file. So what do we have here? Oh, come on. Let's zoom here. December 2020, the Scarpin entered into the following factor arrangement with Corinthians National Bank. Scarpin transferred accounts receivable that had a book value of $1.3 thousand. The transfer was made without recurse, so all the risk we are giving it to the bank. Oh, it's not Santa Teresa, it is Scarpin Corporation. Corinthians immediately remitted to Scarpin Corporation cash equal to 90% of the factored amount. So let's do it here. So accounts receivable, $1.3 million. That is how much we are selling it. How much is our cash? 1.3 million times 90%. However, the difference is not loss. Why not? Because Corinthians retained the 10% to cover its factoring fee equal to 10% of the total factored amount. So they retained $52,000 and to provide a cushion against potential sales return and allowance. Uh, we are not doing anything with this number yet. After Corinthians has collected cash equal to the amount of advanced plus the factoring fee, Corinthians will remit the excess to Scarpin. However, therefore, Scarpin has a beneficial interest in the transfer receivable equal to the fair value of at least 90% of the receivables to be collected. So what do we have here? And which managed estimates to equal $100,000 less this factoring fee. So uh, if everything goes well, we will receive some money after this collection. And the fair value of this money, it is equal to $100,000 less the factoring fee. So our receivable will be $100,000 less $52,000. It will be 48. And now we need to balance it with gain or losses. What do we have here? Our credit, so let's sum here. Our debit will be 1.2 million, our credit 1.3 million. So we need a debit to balance it. So we have a loss. Usually we have losses here. How much is it? 1.3 less the sum of our debits, 82. And now our journal entry is balance. What about with recurs? So let's also correct here, not Santa Teresa, it's Scarping. We have the same numbers here. However, assume the same factor as in the previous illustration, so in the previous Excel file, except that Scarping shows the receivable with recurs and estimates the fair value of the recurs obligation to be $10,000. So what do we have here? We have here the same journal entries here. Cash 1.1, 1.1, accounts receivable 1.3, receivable from Corinthians 48, 48. However, we have this recurs and we estimate that this recurs will be $10,000. So we have a new liability here, recurs liability. Okay, if we had a loss in the previous one and we are adding more credit here, so our loss will be higher. How much higher? $10,000 higher. So the sum here of credits less the sum of our debits. So it will be 92 our loss. And here is the 82 of our loss. So with recurs, we have this additional liability here that we don't have if we have it without recurs. Okay, guys, so thank you so much. Subscribe our channel, please. You will be the first one to know when a new video arrives. Subscribe and also like our Facebook page, Accounting Hub by Dr. Scarping. Like our video as well. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.